Thank you everyone for joining. Hello everyone and welcome to today's webinar hosted by Arya.ai. My name is Sugun Sedev and I'm delighted to have you all join us for an exciting webinar. We have a fantastic lineup for today featuring a paper presentation, expert panel discussion and engaging Q&A session. Our speakers for today are Vinay Kumar, founder and CEO of Arya.ai, and we also have Alban Bellenger, head of strategy at Aurionpro. And as we go along, if you have any questions, please feel free to post them in the chat box below, and we will take them through as we go along. So, to kick off today's webinar, Vinay will be presenting his paper titled Reviewing the Risks of AI Technical Debt in Financial Services Industries. So, without further ado, please join me in welcoming Vinay. Vinay, over to you.
Thanks, Ivan. Let me quickly introduce myself, and Alban will, feel free to introduce yourself as well, so that there is a bit of context in terms of why we're talking about about this topic, and and quick background about that as well. So my name is Vinay, and I'm the CEO and founder for Arya.ai. I have started Arya in 2013. It's been almost 11 years now. Since last decade, we have been focusing primarily around deploying AI within the financial services. Since last 2-3 years, we have been working around AI safety, explainability, and alignment. I'll quickly introduce a quick background about the company as well during the presentation. So that's about myself.
Thanks, Vinay, and good to be here. So my name is Alban. I'm heading the strategy and the operation excellence for Aurionpro. I've been with the company for a bit more than 6 months now, but previously worked for a lot of big enterprise fintech. A quick word about Aurionpro. Aurionpro has been around for more than 20 years and specialized basically in banking, fintech, and tech solutions. Aurionpro was partnered with Arya.ai a few months ago, so we are very pleased basically to work together with Vinay and the team. We see really AI as transformative for us. Vinay, back to you.
Thank you. Awesome. So let's not get let's start with the presentation. So I hope everyone can see my screen. So I have recently published a paper called Reviewing the AI Technical Debt in Financial Services. Today, I'll quickly talk about the gist of it, a bunch of observations, and why is it important to study this in financial services industry. Quick background about Arya, as we mentioned, so we started in 2013. It's been almost 11 years now. So we were one of the first deep learning startups out of India. So we have a heavy baggage and experience when we talk about some of these concepts, because we see these things quite repetitive and quite often in the industry. So while we have been talking about working on deploying AI since last 2-3 years, we had set up a new product team called Arya.ai. The primary motivation for this team is to try to make AI explainable, safe, and aligned. Because these are the 3 issues that we continue to see becoming critical and important when we use AI in mission critical functions. So currently there are a team of almost 12 Arya.ai product team, and our key goal is do a bunch of research, publish a bunch of case studies, invent new techniques, be it on the explainability side or alignment side or safety side, for example. So now coming to the concepts. So quick, I'll touch base upon the definitions of these concepts, and then I'll go to the observation. First off, technical debt. So this is primarily used in software, first introduced in 1992, where the idea is, when you deploy a software with certain compromises, with certain, what you say. So you would have missed those things willingly or unwillingly. And your intention was to look back at them at a later stage. So you kind of created a debt in the product. And this is what becomes challenging or mission critical in terms of functionality of the main product itself. So these technical debt is also applicable even in AI deployments as well. So the first time it was talked about in 2015 by David Scully. If you have read that paper, there is a nice graph which shows model is probably the very small part of the AI solution. You have a bunch of things that you would have to take care of the solution acceptability from a risk standpoint or technical debt standpoint. So technical debt is nothing but primarily, compromises that you would have taken, which in turn creates a risk in the business, right? It could be a financial risk, operational risk, business continuity risk, or regulatory risk, or reputational risk. So these compromises are either in terms of data preparation, data collection, testing, your ML observability setup, model risk management setup, explainability, regulatory, and all that stuff. So this is what we are going to discuss today. What are the different technical debt types of technical debts that we foresee when we deploy AI in financial services industry, and what are the risks that we foresee from these kind of technical debts. So typically in financial services, the expectation is, so there should be a transparency in the product. So you have builders and users. Builders are primarily the data scientists or third-party vendors who is providing the product. And then the users are internal business owners, or the end users, or the customers themselves, or third-party users like risk team, regulator team. Those become the users of the entire solution, right? So the primary criteria when financial services expect from the AI product is, first off, is the transparency. It should be clear in terms of how the decisioning is, how does it happening, and what's the reason behind the decision and all that stuff. Second important thing is the bounded risk. So when I use a product in my process, I expect there is a bounded risk such that I can manage that risk. If there is an unbounded risk, then that becomes a business continuity risk, right? Because you can't control it, you don't know what's happening, and something can create a massive challenges to the business. The third is the promise SLA. So you are investing on the product and you would expect that the solution will deliver a consistent standard output such that you can expect calculate the ROI and the returns, including the risks and everything, right? So then only it makes a viable a solution to use. Fourth is the auditability. As financial services deals with a bunch of risks, compliances, and regulations, auditability is one of the important factors, so that there is always a look back on a certain process, and there is clear traceability on the process as well. Fifth thing is the compliance. So now there is more emerging clarity around regulations, be it by the industry-specific body or the entire governing body in the geography. We see more regulations coming around AI, more standards coming around AI, which means the solution should be compliant as well. Net, this is what the expectations from the financial services industry. If these doesn't meet at scale, then what it leads to is failures, be it in a conversational error. Let's say there is a hallucination and you didn't address that properly, then that does create a bunch of wrong answers. It could be wrong information which can become super critical for the follow-on guide, or it could be some wrong action because of your agent executing something wrongly. Or even in simple predictive models, for example. So you would be using these as a base for a certain process. If these models fail, then your entire process will start failing. So there are enough examples in the industry right now, primarily emerged in the last 3-5 years, in terms of what happens if you don't do it right. Instead of getting any positive ROI, it just creates a bunch of issues to the business. It could be financial loss, reputational loss, regulatory risk, and it can even damage the trust on the entity as well. So it's very, very important to understand the risk of using such solution, and at the same time manage these risks as well. So this is the primary motivation for us to publish the paper around technical debt. Because whatever we have read, these technical debts were very generalistically talked about. There was no direct correlation, and there were very certain nuances in the financial services industry, which may not be applicable in other industries. So this is why we thought it would be good to publish these technical debts, so that if you are deploying AI, you can always benchmark and see how well you have addressed these technical debts in your solution, how well you manage the risk in these solutions. So coming back to the core observations, as I said, so technical debts are typically compromises. It's a debt that you have to repay as soon as possible, or else this can lead to a tremendous amount of risk to the business. So these debts were categorized into multiple buckets. Broadly, given the sense and nature of the debt, either it could be based on the source or it could be based on the risk categorization. we categorize these debts into a total of 7 different buckets. You can always choose to further categorize it or further consolidate it, but this is more from a reference standpoint. These categories are things like data-related debts, meaning how are you preparing the data, how are you maintaining your training data versus testing data, for example. We'll talk about in these details, but these are primarily talking about debt related to your data preparation and how you're supplying this data to the model. Second is on the model architectures, meaning what kind of architectures were you using, how conceptually sound these architectures were, what are the issues that you would have started looking at because of the choice of these architectures. The third is the testing and monitoring, meaning how are you testing these models, what kind of criteria, what does make sense, what doesn't make sense, what other things you should start testing or monitoring, like drifts, for example, bias. Those are again the third category of debts. So fourth is the regulatory and compliance. Again, so it's a very, very emerging risk in the current scenario, whereas there is a very high weightage, but at the same time, less amount of action. Only in the recent times, we started seeing a bunch of action around the regulated debt as well. So first is the audit and traceability. So what happens if you don't do auditability right? So how does that impact? Again, how is that debt impacts your business, all that stuff. So sixth is the model risk and safety. MRM is very traditional process, but traditionally it's always looked at a simple statistical model or process-driven kind of model. But when you start using ML or AI, it's a very different kind of story. So what are those emerging risks? How are you managing them as part of your MRM model risk and safety debt? Seventh is user participation. So this is another thing which is very nuanced, particularly in financial services as well, which is how well your stakeholders were involved in the solution, were they aware about it, or how well they are aware about it. How are we sharing the information between the stakeholders? So those again form seventh category of technical debt. So these are the different kind of technical debts that we have observed when we deploy AI in the FSIs. So let's start with the data related one, right? So for example, when we talk about data preparation, so there are many things that we observe typically a data scientist would follow. So first off, things like data feature exclusion, for example. So there is this classic process where you try to do a bunch of feature engineering and dimensionality reduction, and then you come to a conclusion that I may not use these features in my model. So these are sometimes very simple statistical rules or observations, or sometimes a little bit more mathematical driven. So while it may sound really nice from a math standpoint, but from a business standpoint, this may not make sense. For example, let's say I have features F1 to Fn, and some features I'm excluding because it has a larger amount of missing values. So let's take an example of lending case study, right? So I have a lending data where one of the features is number of public bankruptcies. I'm referring to Lending Club data, which is a very well-known open source data for lending process. You may have a similar features like that. So the idea is, if you look at number of public bankruptcies in that data, as bankruptcies itself is an occasional event. It's a very rare event, but it's a very important event to an underwriter. But that is a very less filled information, right? Because not many people would have been bankrupted, or not everyone who has bankrupted is coming to your business for a loan as well. So that universe is quite small, very unique kind of universe. But if you remove that feature because 90% of that data point is blank, then you are necessarily missing out that information provided to the model. So model will not have any information on how to treat this when that data is present, right? But for an underwriter, this is probably one of the most important feature to decide whether I should give a loan or not. So this kind of counter reacts to the base process of feature selection, right? While you can still apply certain statistical principles and mathematical principles while finalizing the features, but you should take a certain input from the business to figure out what are the final features that have to be part of the model or part of the solution. If not, you create a debt which is going to be really, really critical When that feature comes in production, the model may not know how to treat that. Then you would probably issue a loan where, and counter perspective, a human would never have done that in reality. So this is what we observed in solutioning. While you follow a feature exclusion process with a very sound statistical principles, but you may have created a debt which can become critical to your business. Second type of debt that we have seen is it's kind of a little bit more nuanced, which is over engineering or under engineering the features. So typically in data preparation, again, there is a process called feature engineering where I may convert data into a certain kind of dimensions which can feed into my model. So for example, let's say I have raw features like F1 to Fn, and then engineered features is E1 to En. I would have done over engineering. So over engineering is I may combine 2, 3 raw features to create an engineered feature. And when I start using this engineered feature, and when I do explainability on the engineered feature, because your explainability will always be on the engineered features, right? Then it becomes really hard to understand how the model is using your raw features to give you that output. So it becomes really hard in terms of how you're going to explain model functioning if you over-engineer the features to that extent. And counter to that is oversimplifying or under-engineering the features. So we also have seen things like, let's say you have a raw feature F1, where values are, highly cardinal, or maybe textual data, for example. So you have values like V1 to Vn. So typically we see things like you will do one shot for V1 to V4, which is top occurring features or top occurring values. And for the remaining ones, you simply categorize them as others. This again creates a similar kind of behavior like excluding a certain information from the model. So this also creates a debt in the model where you are over engineering the features, and then you create bunch of complexities as when the model starts giving the prediction. Or you are under engineering the features or oversimplifying the features, where you are excluding a bunch of knowledge from the model and simply using a very limited amount of data for that data point. So in both of these scenarios, it creates data debt, data preparation kind of debt. So data debt, and then another thing that we also have seen is differences between data capturing from your training data and testing data. So this is what data inconsistencies are. So this is very, very common in financial services where people typically use another system like data lake to collect the training data, whereas inferencing always happens in the production systems like the workflow system. So what we have observed is in your data lake, it is probably one record for a transaction, whereas in your workflow, you may have multiple records. For example, let's take again a loan underwriting, right? For a loan underwriting, you may have different amount of transactions. Each transaction would have certain additional information. Whereas for that transaction, you would probably be overriding your data lake information. So because of it, you are simplifying the data, training data, and compressing the data, and you're storing that information in your data lakes. Whereas in production, you have a lot more parts, a lot more information available in your workflow information. So then what happens is I'll train my model on my training data. And when I start using in production, you start seeing model failing very, very quickly. In fact, as soon as you put that model in production, you notice that model performance is really bad. It's very different as compared to your training data. So these inconsistencies will create your data preparation debt as well. So one is inconsistencies, third is exposing the features. The second is excluding the features. Third is over or under engineering your features. These are the different kind of debts that we have seen from a data preparation standpoint. Next is the explainability debt. This is very underlooked debt at the moment. So if there is so much of fascination to move models in production, many times people don't use explainability, or they use wrong explainability. So these are the two things that we have seen very, very, very common in the financial services space. So typically, what do we mean by explainability, right? So whenever a model is giving a prediction, so it could be loan underwriting, it could be a conversational output, agent action, for example, or a prediction output. You expect certain explainability from the model or from the system such that it can help you understand how the model has arrived at that prediction. But the complexity here is that explainability means different for different category of users. A business user would want to understand explainability from a different point of view. Like, how does it consider these features? What happens if I change this? What is triggering what is important for the decision? What is the reason behind this kind of behavior, for example? So for a business user, the explainability means very different set of things. Whereas for a risk manager, again, explainability means very different set of things. For an auditor and regulator, it's a very different thing. For an end user, it's a very different thing. They just want to know why my loan is not accepted, why my loan is accepted, what happens if I change this, why is that similar data to another customer, it was very different kind of decision to that customer, for example. So each user has different kind of explainability outcomes. Now, depending on the technique that you use, like this is a classic complexity versus explainability graph that many technical references that you would have seen. One is either your model is intrinsically explainable, so your model is able to generate explanations as part of the output, or you have to use certain techniques to be able to do that either post hoc or as part of the inferencing itself, such that you can start explaining your model prediction. But the explainability complexity goes up really, really exponentially as you start using more complex techniques. So for more complex techniques, it's very hard and very computationally intensive to do explainability, whereas for simpler models, it may be easy to do. And then the counter is, the more advanced the technique is, probably you will get better performance. But again, this is depends on multiple things like your quality of data, availability of training, and all that stuff. But if let's say you have a very good quality training data, then more advanced techniques would always give you a better performance as compared to a very simplified kind of technique. So you have enough motivation to use more complex techniques, but if you can't scale the explainability, then these models can't become acceptable by all stakeholders. Now, next comes, what kind of explainability should we do? So you could actually probably categorize this into two broad buckets. One is true to model, second is a surrogate. So true to model is you are trying to use understand the model and try to generate the explainability by looking at the model. Whereas in surrogate models, you are trying to assess things like input-output, or you're trying to do some perturbations, for example, to try to assess the model behavior and expect the performance. So which one to use in what scenarios, right? So surrogate model, the drawbacks are so you may actually derive different explanations at different time periods, like in sharp and live. If you change the settings, even though the technique is same, you will get different explanations. Meaning, for user A, I'm giving explanation one. For the same user in a different time period, I'm giving different explanations. So there is a chance of giving a wrong explanation. There is a chance of attacking these model behaviors as well if you're using surrogate models. But true to model explainability, as I said, is very, very complex, computationally intensive as well. So people have used sharp and line as a very classic explainability technique for many of the tabular data sets, because for those tabular data sets, these are very standard explainability techniques. But there were many studies, finding things like, they are easily hackable. People have done scaffolding attacks, whereas in this example, for example, you could see that the ethnicity was used initially, but after doing enough attacks, the ethnicity explainability is kind of negligible after a certain number of attacks, right? Which means you could actually hide the actual model behavior and show different kind of explanations when you use things like sharp and line. So this is where it creates a lot of confusion for a regulator, right? Meaning, should we allow sharp and line as an acceptable explainability output or not? But if these are not maintained properly, then sharp and line are not the right explainability techniques to use. So this is what it creates a dilemma, right? So should I use a complex technique with no explanation, or should I use a technique with the wrong explanation? Both of them carry actually, a complex set of debt. Having no explanation means, black box. It may not be explainable. Not every user will be comfortable with this kind of outputs. The wrong explanation is you create distrust. you create confusion to the users because same model, same explainability technique, it gives me two different outputs, meaning something is wrong with the model, something is wrong with the explainability technique. It creates more confusion than more confidence if you use wrong explanation. So both of them carries a very complicated kind of debt. So this has to be looked at and addressed properly as well. So we have covered two major things, which is on data preparation. Second is on explainability, which is primarily related to model architecture. And then comes the monitoring, right? Meaning many people kind of have a false assumption that once the model is ready, then there is nothing to do with it. The model will work beautifully well in production, and there is no intervention required and all that stuff. But in reality, the model will always, or at least majorly, primarily degrade over time. It's the nature of these ML models. They are probabilistic in nature. They depend on multiple things. And if you do things like continuous learning, it could create a very drastic kind of behavior in production. So if you don't monitor them properly, you don't even know what's happening inside the model. You may assume that my model is fantastic. I'm doing retraining properly. I don't need to, look at my model predictions accuracy and everything, and it could work properly. So there are enough studies done to study these kind of model behaviors. Like there was a paper talked about temporal quality degradation in AI models. So this assessed close to 20,000 different variations of the models. It observed that 91% of the models started degrading and have varies amount of behavior with time period. So the reasons behind that is things like data drift, concept drift, adversarial attacks. These are the very common things that we see in AI solutions. It could be traditional models or predictive models, or even Gen AI models, for example. This is quite common in AI solutions. So if you don't use any monitoring tools, methodologies, and strategies, then that creates a massive amount of debt. You may be using very wrong model, like in Experian example. They started using model even though there was a drift, and it started giving wrong credit scores to close to 300,000 plus users. Similarly for bias as well. So there was an observation that bias and fairness is again a temporal behavior. You may not see the bias at the time of production, but during the usage of the product and the model, you could see that model has started having a different kind of bias behavior over time as well. So this is what creates monitoring depths, which means you should be tracking these drifts, or else there could be issues like model degradation, stability issues, and you can't quantify the risk of these models. As I said, you can't establish an SLA around these models if you can't monitor them properly. And bias and fairness debt, monitoring debt is again something that you would have to monitor in production as well, such that you are monitoring these biases in your model and able to track them properly. Next is the testing debt. Testing is again, we have seen that people may use a wrong testing criteria or over tweak it for a certain kind of testing criteria. Both have equal amount of impact on the model. Take things like LLMs for example. We have seen enough examples where these models work really fantastic on a standard benchmarking criteria because there could be some kind of training data poisoning or over tuning on these kind of testing criteria. But when you take it in production, it may lead to a different kind of behavior. So the recommended behavior is you should use a combination of model testing. And one more thing that we also have seen is to preserve the training data, people start using majority of training data during training itself, and they left with very small amount of testing data, which means they are under-tested the model. They have not tested the model for all scenarios of risk, and they observe it over time. So this also happens very commonly in financial services because financial services is a very trend-driven business. Like each month, each week in a year has different kind of trends. If you have tested only for certain, let's say, time period, let's have tested it only for Q4 of 2024, it may not behave exactly the same in Q1 of 2025 because Q4 may have a certain trend behavior which may not be applicable in Q1. So you may not have tested the model for that scenario. So here, testing it properly using different combination of matrices will balance the risk. So just don't assume that F1 score is really good, which means my model is really good. You may have to use combination of matrices. You may have to use different kind of testing criteria depending on your problem statements. So next is the regulatory and compliance risk, right? So this is an emerging risk at the moment. In fact, emerging most important risk because so far you may have invested heavily on certain solutioning where you may have started using it or you may be going to use it, which may not have covered any of these scenarios from a regulation standpoint, compliance standpoint. But as soon as they become applicable, then your entire solutioning efforts become nullified. So, for example, RBI has launched model risk management guidelines in 2024 August. RBI mentioned very clearly on certain requirements from using AI or ML for things like credit risk assessment, for example. So there are multiple things that have been defined by the regulator. So let's say you invested heavily in a certain solution which doesn't apply to these guidelines, then you can't use it after 6 months because that's the implication timeline for the regulation. Same thing for AI Act or US, for example. There are a bunch of new regulations coming in. So which means you should always be thinking about these regulations as part of your product, these compliances as part of your product. Or else you create a very massive debt where as soon as these become applicable, then your solution entirely becomes unusable, or you may have to reinvest the entire investment again to make your current investment usable going forward. So this is another thing that we have seen, but we also have observed that these regulations are also not fully foolproof, fully transparent and acceptable at the moment. For example, things like there is certain guidelines, broad guidelines across the regulators, like things like should be explainable, should not be sensitive to protected features, should not be biased. All these different criteria were given, but there was no reference of standardization. For example, explainable, as I said, explainability is very contextual. So what is acceptable to a regulator is not clear in any regulation yet. What is an acceptable bias monitoring is not clear, except there are certain definitive terms, like what kind of features that you can use and you can't use. Those are clear. But there is a need for emerging clarity on these as well. But this is where it's better to be prepared upfront than regret it later. So this is what is required from a regulatory debt standpoint. Not deploying solutions without regulatory and compliance oversight. Poor self-governancing framework. This is at least a minimum set of criteria that you should be using whenever you are deploying AI. You should have a governancing framework. You should have a criteria of acceptable risk monitoring, standardization of terms and terminologies, those things. Then you could actually prepare, a very standardized set of process inside the business. If not, then going forward, it limits the scope of usability. It creates a bunch of regulatory incompliances, which may lead to heavy fines or entire business continuity risk as well. So this is on the regulatory debt. So while these are very traditionally talked about concepts, but ML, in AI, we have seen new kind of risks emerging as well. So these are very, very new kind of risks. Some of them were very well marketed at the moment, like prompt injection attacks. Probably many people would have heard about it. But this is not the model attack is not just limited to LLM. It can even happen things like, for example, deep learning models, where people can do model cloning attacks. Adversarial attacks is quite common. So as you start using AI ML, these attacks can not only compromise your model behavior, these compromises your data privacy as well. So if I can do the attack properly, I can get the training data, which is the customer information, which violates the Data Privacy Act, right? That's one. Second is if I'm introducing a bunch of adversarial information into the model, and you're using these information to retrain your model. So, attackers can become really smart to be able to fine tune your model to act for their expectations and use that behavior later on to exploit the entire system. So it's a very emerging concept like cyberspace for software. AI safety is going to become really, really important for AI applications going forward. So these are very new, but you should always have some oversight in terms of, so how are you managing those, or how is that kind of taken care of going forward? Some bit of thought process should be given while solutioning these AI models, or else you again create a debt where that can become an exploiting point for the attacks later on. So this can also happen things if you are using things like using shadow pre-trained models. Uh, we understand that many of the AI solutions today are based on pre-trained models supplied by certain providers or open source. We would suggest to test them properly before you use them in production, because you don't know what is the source of these pre-trained models, what kind of information was fed into. There was little to no transparency in terms of what was the training data and all that stuff. And if you're using LLMs and generative AI, it can create very nuanced problems for you, like copyright issues, for example. Let's say I use copyrighted data in my foundation model, and I supply the foundation model to you to build your product. Then the risk is kind of pari passu, right? So you will also carry that risk as well, because you are using copyrighted information in your own models, and that creates a follow-on threat. So this is why, if you look at some foundation models providers like OpenAI, Anthropic, or kind of indemnifying you using the output. But that's not the case when it comes to open source models, right? So open source models, the entire risk is you are carrying that risk as well. So be sure in terms of where you are sourcing these pre-trained models, is there is enough transparency or enough trust from these sources of pre-trained models as well. And then the model attacks, as I mentioned, is something that should be taken care of, if not immediately, at least progressively as part of the AI solution as well. Next is the auditability and reproducibility debt. So it's a very different kind of process as compared to software. Software is largely process driven. So in process, you will follow the same process time to time. So it is easy to achieve auditability there and traceability in software. But in ML, it's a very complicated process. And second, it's a very dynamic process as well. So one, it's a very complicated process because so far we talked about bunch of debts, right? So every one of those pointers should be tracked and captured artifacts properly, or else you don't know what people have used at the time of data preparation, modeling, testing. You will not have any clue, and you may not be able to reproduce that as well, or you may not be able to do the traceability back to the source when something went wrong. So the process itself is quite complex. So your artifact capturing should be that extremely scalable as well, or else you will not have any auditability in the solution. That's one. Second, it's a very dynamic process. So nowadays, continuous learning is a very common architecture people are using. Continuous learning is you will update the model from time to time, either driven by more mathematical, more scientific driven outcomes, like using monitors, or you may do that as part of the sanity of the process. So which means you are changing these settings for each variation of your model. So let's say my model version 1 has done predictions M1 case 1, M1 case 2 like that. And you change the model, it does multiple new predictions. You change the model and it does new predictions. Now the auditability is on prediction M3 case M, for example. So for a certain prediction, which was model variation M and case M, so you want to do auditability on that case. So imagine that how much scalable should your auditability framework should have been to be able to do that kind of auditability. So this auditability is not like a hypothetical situation. It can be as simple as you gave a decision and now a customer is contending that decision. It could be a lending output, claims output, or fraud investigation, or compliance to the regulator, right? Then you have to go back and see what has happened on that decision. And additional complexity for financial services is some of these transactions carry a very long-term auditability risk, which means your decisions are not applicable for just 1 year, right? Some customer can come back after 5 years and ask you to provide the auditability on this. Regulator can ask you to do the same thing as well. So you are carrying the risk for a very long time. So hence your ability to scale the auditability is quite important. So in scope of things, you're doing model update, you're doing data update, you're doing model retraining, your risk selection and risk criteria changes from time to time. So then how are you able to track the models? How are you able to do the case-wise tracking? Given that there are tens of models and soon you will have hundreds of models in your business and your chain of responsibility is never consistent. You're always changing the team. You're always having an attrition. Some data scientists leave, some risk manager leaves. They carry everything with them if you're not capturing all these kind of settings and artifacts. Uh, so this is one of the very hard problems to solve just by the nature of this. It's not a technical problem, it's more of a, again, artifact capturing kind of problem. But this does carry a humongous amount of debt as well. Um, so last but not least is the stakeholder participation. So this again very new, very sometimes it would have addressed really well, really easily, but users most of the time complicate it. For example, we have seen enough examples even within ourselves as well. So all stakeholders may not involved in the entire process. For example, if I'm developing a credit risk model, whatever I've done from end to end should be understandable to the head of underwriter or the underwriter or head of risk, right? So that they know that what I'm considering from settings, data selection, feature selection, testing criteria, the usability risk is understandable by all stakeholders. But there is an intrinsic assumption that this is too technical, people don't understand, hence they may not share the information, or they share the information, but the stakeholder doesn't understand it. This intrinsically creates gap between the user group and the builder group. When it goes in production and when something happens, then suddenly everybody starts realizing that it should not have done from the beginning. This is a very common process-driven kind of debt. But not as there is no clear process in deploying these solutions in the FSIs. There is no clear tracking as well. So people always assume that fine. So it's an AI, it's magic, it does everything on its own. But in reality, the guy who builds it is the guy who is the expertise that you should see in the AI. It's a very builder dependent solution. It's not a universal kind of output. I could use the best open source model or the best foundation model, but if I don't use it right, I'll get different output, you will get different output. So it's important to engage all stakeholders at each step and keep them communicated and notified about this information so that all of them are aware about this set of data. And all of this should have flown back to the risk management, right? Whatever the technical debts and risk areas that we talked about is a new monitoring point in your MRM tool or in your MRM framework. If any of these is not followed very well, then again you may not able to scale your model risk management well enough, and you will fail, and then it creates problems again. So in AI, MRM is quite hard because the techniques evolve. As the techniques evolve, you have to reinvent the model risk management again because it introduces new scenarios, it omits old scenarios. So you will have to redo this continuously and able to scale up your team to say that, fine, you have a very good audit capturing framework, and you have very good risk management framework, and you have other set of frameworks that is required for your solution to become acceptable. So these are the broad set of risks that we have seen. Just going back and summarizing this again very quickly. Yeah, so these are the 7 different kind of technical debts that we have seen. So data preparation side, as I mentioned, your training, testing, ability to maintain them properly, data omission and engineering should have addressed properly and should have oversight from the business so that you are managing those kind of debts. Model architecture point of view, like explainability, for example. So one is, while you can use certain techniques, but you should actually use more number of techniques to be able to have a triaging from an explainability standpoint. So explainability is again, is an experimental kind of output. So you should experiment continuously and see what is acceptable for different stakeholders and then scale it up. Testing and monitoring is, you have things like not testing enough, not monitoring the drifts, not monitoring the bias at scale can create a risk for your business. Regulatory compliance, regulations are becoming more clearer in terms of what you can do, what you can't do. While some things are going to evolve, self-regulation is something that you should scale, or else that can create a debt in your business. Audit and traceability, as I mentioned, it's a very process, highly complicated. If you start doing things like continuous learning, and if you're using multiple number of models, then that should be scalable as well. All this should be addressed in your model risk framework and should be scaled as well, going beyond the traditional model risk management lifecycle, or else the solution can create risk and that is not managed. That can create a direct loss to the business. User stakeholder participation, as I said, it's a very simple process driven, but it's good to have everyone kept posted in a language that they can understand, so that there is no counter questions at a later stage around the solution. So these are the different kind of risk, technical debts that we have seen, and the eventual outcome is if you don't manage this properly, it creates financial risk, meaning you would be running the business on certain assumptions which are actually not true. It can create operational risk. It can create business continuity risk. Regulators can question and probe back on your process and the decision. And all in all, it creates a humongous reputational risk as well. So it's not a matter of who has productionized the AI first. It's a matter of who has able to scale the AI first is going to be the most important thing. We have seen enough examples where a large amount of enterprises were able to productionize it first and later on rephrase it because they underlooked multiple things which created problems for them. Whereas certain entities done it right, done it properly through experimentation, using tools, all that stuff, and they're able to get actual value out. So this is what we want to achieve, by giving a set of references in the paper. So yeah, so this is what our observations were. So we will. So the paper is anyways published as a preprint in HAL. We have, I believe we have shared it. If not, we'll share the paper again. So we have explained these in detail. May not be these kind of examples. So we'll be happy to share the presentation as well. So that's all on the presentation side. Happy to take if you have any questions, guys.
Thank you, Vinay, for that insightful presentation. The forum is now open for the audience to post their questions in our Q&A or the chat section. And I think we have the first question here from Akshay. So Vinay, I'll take that question to you. Are there any regulations in India that can apply to AI?
Oh yeah. So as I said, model risk management guidelines from RBI is straightforward, applicable on any models used for credit risk management. The go live time for that MRM is 3 months if you are building it new, and 6 months if you are already using some MRM tool at the moment. So there are regulations, and RBI is now looking at model risk of using AI more actively. So I think the chairman for RBI also have talked about it recently, last week, couple of weeks back. So there is a serious attention given around AI regulations in India as well.
Great. Right. So we have another question. Many FSIs are burdened with legacy systems. How can they manage AI technical debt while still integrating these legacy systems?
Okay. That's a very common mistake, common debt that we have seen. In fact, in the data preparation debt that I mentioned about, I've seen enough examples where there is a legacy system which can't do much because it's not API supported. It doesn't store information as we require. That makes the data collection itself very compromised process. If data collection itself is very compromised, then anything with followed with it is kind of compromised, which is model training and all that stuff, which kind of replicates that as well. So yeah, so I think the only solution is either you upgrade those systems with these critical things that is required for your AI models to become successful, or change the systems, which is what many people have done in the last 5 years. Again, there is an enormous transition from legacy systems to new age software, enterprise software particularly. So anything that is built in the last 5 years is highly scalable. Anything that is used in the last 20 years is highly limited as rule of thumb from that standpoint.
Sure. Great. So we'll keep the Q&A section going. If you have questions, please post them in the Q&A or chat. Now, next we have an expert panel discussion where we'll have questions for Vinay and Alban. So let's begin the conversation by hearing some opening thoughts from Alban first.
Yeah, thanks everyone, and thanks Vinay. I think that was very insightful. I just maybe one thing maybe where you can let's bring back the topic on FSI, BFSI or FSI, right? So when we talk about bank insurance, where do you see or how do you see them being very uniquely impacted by technical debt from an AI perspective? Um,
Yeah.
share with
Alba, can you
me.
repeat that again? Sorry, couldn't hear you properly.
Yeah. So just centering the question on what you presented to BFSI and bank and insurance, how basically they're going to be uniquely impacted by AI technical debt?
Yeah. Sure. I think anything that carries debt, the eventual outcome is failure of the system, right? That's the most highly impacted outcome. Failure of the system is you invested heavily in building that system, and because of these debt, it's unusable. That's one. Second is another most important thing is you build a system which is actually behaving counterintuitive to your assumptions, and you're using those assumptions as base for your process, right? Or base for your business. Like for example, let's say I have these kind of data debts, and I created a credit scoring model which is intrinsically flawed inside, and my entire lending business is run by these credit scoring models, right? It's a humongous business continuity risk. And then more nuanced ones are regulatory risk and all those stuff, which are correctable at a later stage. But some of these things like business continuity risk is massive if these technical debts are not addressed properly.
Yeah, and do you see already any live example of those bank and insurance doing it? Have you
Yeah.
with your different
Yeah.
discussion basically and implementations?
Yes, absolutely. But this is a very emerging concept. So again, I'll go back to the example of Equifax, right? So Equifax in 2022, where the model started failing because there was a drift, and they didn't monitor the drift properly. They started using the scheme credit scoring model, and the model was flawed internally. So they gave wrong predictions to close to 300,000 plus users. Later on, there was a big PR news around this, like, Equifax giving 300,000 wrong credit score means whoever have used those credit scores, which is primarily the lending institutions, right, or banks, to underwrite, would have a different kind of output. They may not have issued a loan, or they would have issued a loan, but these were wrong. Those decisions were wronged as well. Uh, that created a lot of awareness, particularly in the financial services industry, at least in the US market, for example, because many of these were very close group discussions among the FSIs in that ecosystem. So they started investing on ML observability tools. Like, for example, there are tools like Fiddler, who is known in the financial services space as well, at least used very comparatively okay as compared to other markets. So the ML observability as a business is kind of emerging to address these technical debts. We have seen software observability, right? Like New Relic, Datadog. They are known for addressing the debts in the software lifecycle. Now we are seeing things like people like Fiddler, Truera, Arise, Aporia, or Guardrails, for example. So these are the different kind of companies that are emerging, who are providing tools as a solution to these technical debts. In fact, just not to promote what we do at Arya.ai, that's the intention for us as well, right? To be able to manage at scale, to be able to do or address these problems at scale is very, very complex. Building a model is very different as compared to making the model acceptable. So model acceptability is a new business opportunity, which is where these technical debts will play a major role.
No, and I think we've seen that, right? We've seen more and more people building model, and we see everyone with a model ready somewhere on the sandbox. But bringing that to a production environment and on what we want to call enterprise AI has been quite difficult, I think, right? And
Yeah,
for the reason you have mentioned. Uh, there is maybe something there's maybe a shortcut that we want to try. So we look at technical debt. In software, one way to remove technical debt is to start from scratch, right? Is just use the latest technology. Is that a viable option for model? Can we just retrain the model from scratch, and then basically we'll skip all the technical debt that we may have accumulated? You were mentioning about the cycle, one from zero
yeah,
to end. Can we just, go back to cycle zero, and then
yeah.
is that a viable thing you think we can do?
Yeah, I mean, that is viable to some extent, right? So in AI, it's a similar story. So let's say there are two things. One, I'll retrain multiple times so that my data is, replenishing every cycle. But you create additional debt, which is the auditability debt, right? So fine, you're retraining, but are you capturing those artifacts as well as possible so that your auditability and traceability is well defined? While it can remove certain debt, but it will also add new debt. Same thing happens in software as well. So when I migrate from one software to another software, for example, let's say your previous version of the software capturing data in certain type, and now you are changing the data capturing in a certain new manner. So how are we going to map between the old data capturing process versus the new data capturing process? Creates additional debt. While you may have addressed certain things, but you create a new debt in the process, right? As long as you know how to address that properly, like doing that column mapping properly, doing that the frequency properly, in software, in AI, it's primarily the traceability and auditability that going to play an important role. The same thing can also happen when you migrate from one technique to another technique. Again, you introduce new things, new debt, and all that stuff. All in all, it's a very both process and technical dependent kind of process. As compared to in software, it's primarily a process dependent kind of process.
No, for
Yeah.
sure. Let me ask maybe a slightly different question, because you touched this on the regulatory side. I think there were as well one of the questions, right? What are we doing in India? What are we doing in Europe? Do you see basically the, the technical debt being basically a blocker for adoption of AI? And maybe for the regulators to adopt AI. Do you see that really happening? What has been your
Yeah.
discussion with the industry leader?
Yeah, I mean, I would love to hear your thoughts as well. So I'll probably discuss in terms of what I have been hearing from a seller side, right? Because we are typically selling these AI ML products to customers. So we would always see, in certain use cases, they are very clear that they don't want to use certain techniques, like credit scoring, for example. Certain geographies are very clear that they can't use black box models. They need to have a clear explainability. They can only use this set of features. This learning is an output of probably 5 years of multiple fines, multiple corrections that they would have done as part of their business. This is a classic case in US, right? In US, the MRM were introduced there almost 10 years back. In UK, MRM guidelines were introduced a couple of years back. In India, just this year. So the maturity is very different from each geography, which means the scrutiny is very different. So certain geographies, they are very clear in terms of what they can do, what they can't do. In certain areas are still very new. Like explainability is very new for everyone. Everyone is trying to figure out how to standardize explainability, how to standardize monitoring, for example, auditability, and all that stuff. Whereas they are some geographies are very clear in terms of bias. What can they use, what they can't use, for example. So that's a real blocker. But at the same time, some people are a little experimental. I know a lot of examples where they used very advanced techniques as an assistant, not as an automation, such that they are having a human in the loop for certain model outputs, and thereby they're trying to address this problem. So this is what I've seen from my point of view. But given that you are
Well,
on the yes.
if I can add on that, so I think from the regulator perspective, it's not an easy task as well, right? I think they have the customer, the client perspective in mind. They want to make sure that clients are protected, right? So the banks, the insurance, if they underwrite loan or if they underwrite proxy, they want to make sure that basically consumer is protected and they get a good service. So I think in that current environment, that new technology and the fact that this is moving extremely fast make it probably very difficult for the regulators to come with very clear regulations. That's where we see a different pace between basically the visions, right? So you were talking about India, but if we expand to Asia, we don't see outside of India most regulation coming from Asia. So that complexity, that diversity that we have between all those different methods from an AI perspective, I think will take some time before the regulator can come back to us and explain basically what we can do, can't do. And as Aurionpro and Arya.ai, as a software provider, of course, it's not always easy to navigate this, right? Because we need to make sure that we develop solution and software that will be easy for our customer to be compliant with, right? So it's been a learning. That lack of global coordination and standardization, I think it's something that is very much, that fragmentation, if I may say, is something that very much we can see now. There is, of course, the explainability is a big thing, right? The capacity to test AI and to explain AI model, I think it's really what is the issue today. There is, unless there is a framework that becomes a norm for explainability, an algorithm that can basically explain exactly what a model will do with that will reduce that technical debt that you were sharing. I think that will, of course, if this happens, that will speed up the regulation, because we'll have basically the same language between the AI providers, the tech providers, the banks, and then the regulators, right? So I think that fragmentation, that globalization and fragmentation today, it's at least is what we see from a regulator perspective.
Got it. And followed with it, right? So again, so you have been deploying and you have been selling as well. So how do you establish a strategy to this? Like, would you be cautious not to deploy, or would you be aggressive to deploy, or how do you? And if you are an FSI, how do you think about this at the moment? How do you establish a strategic advantage and an opportunity for yourself, but at the same time not missing out the opportunity as well?
So what we have seen from our partner, whether it's banks or insurance, is that everyone has been trying to experiment or prototype, right? I think that's what you were sharing, that data to model, it's becoming very easy now to come up with your own model, open source model. And he has this own challenge that you clearly identified in your paper, but everyone has been able to experiment and prototype. So the first step to adoption is probably there today. Now, the level of investment in AI is at a different maturity. So if you take some of the banks, probably in more mature market, they have invested in technology, they have invested in platform, like the one we provide, but not only, they have invested as well in training for their team. The AI ecosystem is totally different, and some bank has understood that. The investment in having basically a team of data scientists, as happened in some of the banks. Some are still at the early stage where basically they will try to just have a sandbox or leverage on some provider. I think the key, and this is where we're trying to position ourselves, is to find a very strong partner and platform on the AI side. It can be, the strategy could be, of course, very different. It can be, I'm going to go and develop as a bank my own solution, but then I will leverage some block and component, or I will just leverage some pre-trained model on a very specific part of my business. It can be on the lending side, it can be on the fraud side. Or I'm into a very regulated market, probably most of the bank in Europe, and then they will have to leverage basically an explainability platform as like an operating system, and then start basically to develop solution on top of it, right? So that's what we have seen. The prototype is here. The adoption remain, of course, today one of the challenge.
Got it. maybe one last question actually. So then how do vendors can differentiate themselves? So as in, where do you see the market emerging towards to? Do you see more DIY? Do you see more solutions or models as a service? Now it is becoming a large enough market where there is a game for everyone, right? From data providers to pre-trained models, all the stuff. Where do you see the demand immediate or going forward? So how do you see the demand emerging over time?
So I think the first thing is that we see demand everywhere in every part of the business, at least where we are today. I don't think there is a single RFP, request for proposal, or a single ask from our clients where there is not some part of AI, right? So there's really a need basically from the banks to, as I mentioned, to trying to explore. Now, the consumption of AI is really different depending of the maturity, as I mentioned. So we see a demand as a service, basically, where you provide, whether in-house or through a service, basically, building model for a specific scenario. And the bank will come with its own environment and will be very productive to the data, not sharing it, keeping everything in-house. That's one case. So then that you will sell basically services. The second part is an API approach, right? Which is basically a consumption or a SaaS, you want, depending on how you want to describe it. But the bank has an existing basically system and workflows. They just want to connect to an API. They want to automatically detect signatures. It's going to be probably very specific to a use case. It's not going to be a solution catered. It's going to be a bit more of generic API. But we see this going probably going up and up. It's a type of usage which is not new, which is not specific to AI, but AI basically help you basically to embed in your existing and legacy platform that type of solution. And I think the last part is people developing actual proper AI solutions, right? And this is probably where Aurionpro is trying to invest a bit more time, and where we can make a difference. It means that you want to build inside your AI solution your domain expertise. It could be in lending, it could be in transaction banking for us. Other vendor may decide to invest in other parts of the business, but you want really to mix together that domain expertise with what the output that the AI can produce, right? So you were mentioning about the lending club data, and this is an example of data that if you develop the model, you have a team of data scientists that understand lending very well, they can come up basically with a very powerful underwriting solution. And I think this is going to be the edge going forward, right? Yes, you will have a bit of commoditized offering, but the domain specific, the enterprise AI will be really how we differentiate ourselves, at least from a vendor perspective.
Excellent. Great, awesome. I think that's all from my side. So yeah, so if there are any questions from the audience, would be happy to take that as well.
Sure. Thank you, Vinay and Alban. That was such a thought-provoking discussion. Now we leave the audience to post their questions again in the Q&A or chat section. If you have any questions, please post them and we'll be happy to take it.
Yeah, I guess we are already almost over time. So maybe one last question and then, yeah. Cool. I don't see anything at the moment. That's good. It's fine, I guess.
Yeah, we have one question from Katie. So, how do you foresee AI technical debt evolving as FSIs increasingly adopt more advanced AI technologies?
Yeah, so that's the other thing. I think with technique, you may carry additional debt. Like for example, generative AI. Generative AI is more prone to be attacked easy as compared to traditional ML, more harder to explain. While it can give you certain advantage in the performance, but it does add additional debt. So like we were discussing, so there is additional debt that you would carry when you do retraining or change the technique. That's the same thing here as well. And many times it gets actually exponentially more complex on certain things, more easy on certain things. Like generative AI is very, very complex from an explainability standpoint. Performance-wise, maybe little stable, but model attacks, again, very, very high on technical debt. Regulations-wise, nobody knows how to manage the Gen AI regulations at the moment. So it's whenever you move from one stage of techniques to another stage of techniques, everything changes. So this is why the scalability is quite important. So yeah, it's a very different thing.
Sure.
Okay.
Thank you. And I think another one for we have for Alban is we have been hearing about the possible transformative power of AI from various sources, but how real is it in FSIs? Alban, if you would like to take that first. Yeah.
Yeah, so it was. um, yeah, so the I think for FSI it's been always a different game, right? So yes, they probably are slow to take to adopt this, but I think the potential for them is really big. Um, they're always looking basically for a better efficiency and a better cost reduction. This is why basically they have been adopting technology and AI the same way, right? So the way they can create values to their clients is basically servicing them the fastest, the best, right? And AI may enable them basically to be more efficient and basically do it as a reduced cost. There is as well very specific part of the bank, the insurance, or just a financial institution where basically uh, AI can be really transformative, right? Fraud detections, risk management, anywhere where basically you have either a lot of volumes or you need a lot of expertise, expensive expertise, there is an opportunity basically for this type of model to be really transformative. And I think probably the last part is on the customer experience. Banks always have and insurance have been the best basically to provide the best-in-class customer experience with mobile access and so on. Of course, things have changed and the maturity of this is different from one country to another country, but we could expect that this helped them basically to provide really tailored journey for their clients and their end customers, right? So those type of innovation, I think they have always dreamed about it, but legacy system has been, and in fact, technical debt has been a big issue for them, right? So be able to bring those type of innovative technology can really help the NFSI to get an edge basically against their competitors, right? Especially in the banks and the insurance side. Whether you're on the retail and corporate, retail of course is an immediate one, but corporate will be definitely an avenue. And we've seen that. We've seen a wave of corporate banks basically coming to us with asking for innovative solutions. So that will be for me the 2 3 main topics.
Sure. Thank you so much. Just keeping in view of time, now we wrap up, and I want to thank Vinay and Alban for sharing their insights with us today. It's been truly enlightening session on the risks and management of AI technical debt. And thank you to all of our participants for attending, engaging, and making this a success. We will be sharing a feedback mail and also the recording for this session. So please do share your feedback for our event and so that we can improve your experience for the future events. Have a great day. Thank you so much, everyone.